Hey everyone, my name is Paul Vojchehoske, and welcome to the Real Estate Classroom YouTube channel, where my mission is simple, and that's to help you pass your real estate exam the first time. All right, let's get back to our vocabulary words, key vocabulary words you need to know to pass your real estate exam. 252, hypothecation. Now, this is a process of securing finance from a bank, a lender, a mortgage company, whatever the case may be, by pledging an asset such as your house, your primary house, such as an investment property, or maybe it's some other type of asset like a stock, a bond, a car, a boat, an RV. Basically, it's a process that you can use to borrow money and use one of your assets that you have to secure it. That is hypothecation. Number 253, Defeasance Clause. Now, this is a clause in a mortgage contract that protects the borrower. So what happens under this particular clause is if the borrower has completed and fulfilled all the terms and conditions of the promissory note, they paid off the balance and all the other terms and conditions have been met. Now, typically what happens is the bank is going to transfer title back to the borrower if they have title, or they're going to remove the lien, or what we call transfer any interest back to the borrower if there is any. But let's say, for example, that the lender says, you know what, I'm not going to do it. I don't care. You paid the loan off, etc., but I'm not going to do it. Then what it means is this particular clause defeats at that point, because remember, the promissory note, all the terms and conditions have been completed. It defeats that lender's interest in the property. The key word here is defeat. That's why we call it a defeasance clause. It essentially is there to protect the borrower. Folks, if you are or have gotten any value out of this channel, please help me support this channel. My mission truly is to help everyone pass their real estate exam the first time. And there are two ways you can support this channel. The first way is to give this video a thumbs up, hit that subscribe button and the notification bell. That will definitely help the channel grow. And number two is if you feel so inclined to financially help out this channel, there is a super thanks down below, right below this video. It's a little icon down there with a heart and a dollar sign, and you want to throw a few bucks our way, that would be so appreciative. Number 254, Alienation Clause. Now, one thing you have to know is Alienation Clause is sometimes referred to on the test as a due on sale clause. We do find this clause in a mortgage and deed of trust, and basically it gives the lender the right to declare the entire amount of the loan that's due, that loan balance, due and payable immediately, should the borrower sell the property or transfer title. It's just a mechanism to protect the lender so the borrower doesn't sell the property, keep all the proceeds, and then never pay the loan off. Number 255 is what we call an acceleration clause. It is a clause in a mortgage or deed of trust that at the point that the borrower defaults on their monthly payments, they stop making the payments, it's a legal mechanism for the lender to foreclose on the property. And actually what happens is they actually accelerate the loan payment, meaning they declare the entire amount due and payable immediately. And that's how the mechanism works. So they accelerate the due date, if you will. And it's just there to protect the borrower in the case of protect the lender in the case the borrower defaults on their loan payment. 256 is what's known as an assignment of rents. I did a video not too long ago on the difference between mortgagee in possession and assignment of rents. It is a clause in a mortgage or deed of trust that allows the lender, upon default in payments of the borrower, so in this case, it's an investor who has a rental property and they stop making the mortgage payment. It allows that lender to reach out directly to the tenant, and then the tenant is going to pay their monthly rent payments directly to the lender. Now, the lender doesn't have legal title. They don't even have possession and control of the property. It's just a mechanism to protect the lender should the borrower stop making their monthly payments. It's a mechanism to protect that lender so they can get that rent money directly from the tenant. Number 257 is what we call a subordination clause. This is a clause in a mortgage or a deed of trust that basically states that the lender's lien against the property will take precedent over any other liens placed on the house. Now, there are a couple exceptions, and number one is if it's like an IRS lien or a real estate or property tax lien, by statute, those will take precedent and priority over the lender's lien against the property. One other thing, number 258, an assumption clause. Now, all of your government-backed loans, such as Veterans Affairs loans, Federal Housing Administration loans, U.S. Department of Agriculture loans, etc., they are assumable loans. And an assumption clause is a provision in a mortgage or a deed of trust that allows a buyer to assume or take responsibility for an existing loan that the seller has. So, let's say that I have a Veterans Affairs loan and I got it 10 years ago and I've been making my payment and I decide to sell my property and the buyer is a fellow veteran and the veteran wants to assume my loan. Well, I'm going to transfer title to that buyer, but they're going to simply take my current and existing VA loan over. And essentially what happens is the names are simply changed. Remember, I've been paying on my loan for 10 years. That means that new buyer is going to get all the benefit of that equity buildup. It simply is taking my loan and all the terms and conditions of this VA loan and transferring it over to the new veteran purchaser that just purchased my house. Nothing changes. The interest rate doesn't change. The monthly payment doesn't change. The payoff date doesn't change. The only thing that changes is the name. My name is crossed out and the new borrower is put in there. Now, the new borrower has to qualify for the loan, but once they qualify, then they can assume the loan. Now, all right, it's a provision in a deed or mortgage that enables that borrower to assume that loan or take responsibility for that existing loan. If you're going to continue studying, check out this video right here. Again, don't forget to subscribe to the channel, comments down below.